morning from cloudy, chilly Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. This is a bi-weekly podcast. Today's date is Sunday, May the 4th, 2025. Before we get started, just a little bit of information about us. Asbury Research is a registered investment advisor, or an RIA, and we have been providing both investment research and asset management to individual investors and professional money managers since 2005. So this is our 21st year in business. We have two levels of research service available. We have our Asbury Premium, which we're going to look at some of the facets of Asbury Premium today, which includes the latest updates on all of our models, all of our various research reports, and some personal instruction on how to use them all, how to integrate them into your own portfolio. And we also have an entry-level Substack newsletter that has a free version and also a paid version for $25 a month. This is kind of an entry-level version to get involved with us if you like our approach to markets. And you can learn more about that at asburyresearch.substack.com. We also manage money for individual investors and other professional money managers just like us via 4 different model portfolios that we have constructed around all of the models that we have built over the past decade. You can contact us right here via the contact tab at asburyresearch.com to request a prospectus on any of these and to schedule a Zoom or a phone call so we can talk about them, explain how they work to you, and see if this might be a good option for you. In today's podcast, our focus is on the enormous rebound that we had in the U.S. stock market over the past month and what it means for the market's direction going forward into the summer months and potentially all the way into the fall, into the latter part of the year. Still with the imminent threat of tariffs hanging over the market, that could change at any time. So let's get started. Where I want to begin today is kind of the origins of the rally that we've had. We had an enormous rally here, as you all know. And what we're going to do is we're going to go back to, this is one of the research reports in the premium service. It's called Keys to This Week. As the name suggests, it comes out once a week, typically towards the latter part of the week. So this went out on April the 4th. April the 4th, market showing preliminary signs of downside exhaustion. What I primarily brought you here for is to show you this chart. We were looking, well, there's several charts we're going to look at. We're going to start here. This is the S&P 500, and what we were pointing out on Friday is that we had a major support level here at 48.19 in the S&P 500. That was based on a high that we made way back in January of 2022, and also off of the rising trend line that was off of the bottom that we made in March of 2020. That was the COVID bottom. And we were pointing this level out. If we got there, that would be a big line in the sand for the U.S. stock market. If we couldn't hold it, we're going into an extended bear market. That could be a lot of trouble for us this year. If it held, who knows? Depending on what happens with tariffs and with some of the other uncertainties in the market. But this 48.19 level was really important to us. The other things that we pointed out that were equally important was that there were signs of exhaustion in the market. We had a sign of exhaustion in the VIX that you see right here, a big spike in the VIX. We had a sign of exhaustion in market breadth by looking at the percentage of NYSE stocks that were trading above their 200-day moving average. There was only a small number of them, and that small number indicated kind of a washout in breadth that had led to other important bottoms over the past 15 years. We saw extremes in standard deviation, and we also saw an extreme in terms of investor sentiment via the investors' intelligence data here. So that's kind of where we are now. We had this exhaustive move down. We've gone into some major support. The support held. The low, okay, this was written on the 4th. So the low on the 7th, the 4th was a Friday. The low of the 7th was 48.35, and our support was at 48.19. So we got within 20 points of our support, and now, as we know, everything is flipped around, and the market's been really strong for the past few weeks. The next thing we're going to look at is what the internal strength of the market looks like right now through this past week. And for that, we're going to move over to the Research Center. This is the paywall for the premium research product. And we're going to move down to the Asbury 6, which is right here. The Asbury 6 went back to risk on as of April the 23rd. So almost 2 weeks ago, the S&P 500 has risen by 6% since then. The Asbury 6 is right here, and it's a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse market metrics, which we selected and put together via a lot of quantitative backtesting. The reason we've built this is because it gets harder and harder seemingly every quarter to determine what the health of the market is by watching the S&P 500. The day-to-day volatility is crazy. There's a lot of noise, as we all know. The market's up 100 today. It's down 100 tomorrow. It's very hard for a professional like me that's been doing this for 40 years to stay with a good idea because of all the noise in the market. It's hard to stick with your position when you're down 100 today and you're down another 50 the next day. So this was to help me, at least for the first few years. It was an internal metric that we had to keep me focusing on the signal and not the noise. And the signal is what we're getting from these 6 indicators, which include market breadth, volatility, trading volume, and other metrics that work very well together as a team. Since 2017, I'm going to change views here real quick. This is the Asbury 6. The way we use the Asbury 6 is when 4 or more of the 6 constituents are green or positive, it's a positive signal for the model. When 4 or more of them turn to red or negative, it's a negative or a bearish signal for the model. So this is the Asbury 6 daily going all the way back to October of 2017. That's the origin of this particular model, according to the backtest. We like to backtest our models between 5 and 7 years back. And the A6 is green, and the S&P 500 is the blue line here. So you can, and this is daily, you can see throughout this period, and this actually goes through May the 1st. So this is very current. This is just through last week. It sticks to the S&P 500 like glue, but it generally performs better. The green line is generally above the blue line. You could see we're about the same right now, but through the history of this has performed better most of the time than the S&P 500. The issue with this, if there is an issue, is that it's pretty active. It was meant to be really an indicator rather than a model. So it's got about 11 round turns a year, which means a little less than once a month. It's making a round turn from going positive to negative. That's a round turn. So there's 11 of those in a year, annualized, going back to the end of 2017. The plus side of this is the maximum drawdown in the S&P right here was 34%. This was COVID. Our maximum drawdown in this particular model was 14%. So almost 2/3 less of a drawdown, and it still manages to stay above the S&P most of the time. So this is a really important indicator for us. We use it to tell us what the internal strength of the market is right now on a very short-term, day-to-day basis, kind of like an EKG for your heart. We want to see all of the little wiggles, all the little imperfections, and right now everything is green. The next thing we're going to look at as we change back in our views is we're going to go to the CPM, which is a correction protection model. This is used as a trading model rather than an indicator. It moves a lot less than the S&P 500. There's about 5 round turns a year. It's currently risk on as of April the 24th. The A6 went back to positive on April the 23rd. And this is what it has done since the latter part of 2023. Green is risk on, red is risk off. You could see right now, April 24th, we're back to risk on. Our first initial risk off was on December the 18th, and then we had that secondary high that we made in February. It also went to risk off there. So CPM is meant to be a data-driven, dynamic substitute for the stock and bond allocation in your portfolio that your advisor sets up for you. Most of the time, when you have an advisor, they ask you some questions up front. They figure out how risk averse you might be, when you want to retire, a lot of other factors, and then they will determine that you might be a 60-40 stock and bond person. So you're in 60% stocks, or maybe 30% bonds, 5% maybe in gold, and maybe 5% in international. But they come up with kind of a set it and forget it strategy for you. The problem that we have with that is we think the market should be telling us how much bonds and how much stocks we have, and not a one-time analysis, and then we're going to let it run for a couple of years and cross our fingers and hope everything works out okay. So when CPM is risk on, as it is now, we are in SPY. SPY is the ETF that tracks the S&P 500. When CPM goes to risk off, we move out of SPY and we move to BIL. BIL is the ticker, and that is an ETF that emulates the yield on a between 8 and 13 week T-bill, which is currently in the neighborhood of 4.2%. So the market's telling us when to be in stocks and bonds, and not the initial meeting that we might have with our advisor. So year to date, CPM is trailing the S&P by just 1.3%, but it's avoided most of the recent market collapse. At the extremes this year, SPX was down 17.8 compared to just 5.6% for CPM. So what CPM has done well, and we're going to move to another view here. So here's CPM. This is a line chart for CPM versus the S&P 500. CPM is green, S&P 500 is blue. This again goes back to Q4 of 2017, and you can see that it's really stuck like glue to the S&P 500. The difference is, and this is important for older investors that may be more risk averse or don't want to take a big hit when they're 70 years old and then hope that they're alive long enough to get that back. This allows us to play in the stock market, and over time, as you can see by the two lines being pretty close together, it's been giving us S&P 500 like returns, but the maximum drawdown in the S&P was 34%. This was 20%. So if you're drawing off of your accounts because you're retired, it's very important to keep those drawdowns small. So we're not drawing off of it with a huge drawdown because the market went down hard, and we're also taking X percent of it out every month so we could live. So that's where we are in the CPM. The next thing we're going to look at as we go back to here we go. We're going to go back to the Research Center. We're going to take a look at our CEF model. Our CEF model is our sector rotation model. The CEF model, right now, this month, or through the end of the week, I should say, the two top favored ones are XLK and XLC. We built this model to be a replacement for that part of your portfolio that always stays in the market. Most investors that I've dealt with, they don't like to go to 100% cash. The managers that we work with, the other RIAs, they really can't go to cash. They need to stay invested in the market with most of their clients' assets. So rather than park that buy and hold money, so to speak, in the S&P 500, we built a model that measures the velocity of money that's moving around the 11 sector spiders, which together comprise the S&P 500, and we determine how fast that money is moving in or moving out of any one of those 11 in 3 different time phases: trading, tactical, and strategic. Right now, the top 2 are technology and XLC, which is communication services. Those are generally 2 of the risk-on sectors. The CEF model is always fully invested in the market. Again, a dynamic alternative to the traditional buy and hold part of your portfolio. According to hypothetical backtesting, since June of 2018, the CEF model has significantly outperformed the S&P by about 7% annualized with less risk. Let's take a look at that chart real quick. So we're going to go back to our secondary view. The CEF model this time is in lime green here, and blue is the S&P 500. So you can see there was a lot of relative outperformance by CEF during the 2021 and 2022 period, and since then we've managed to maintain a pretty good lead, and with a little less standard deviation, a little lower standard deviation, the maximum drawdown is 4.5% less than the S&P 500. So these are 3 different models that we use. These are actual components of the model portfolios that I spoke of that we use for asset management. But these are like staples for us. This is how we navigate the markets with less risk. The last thing we're going to look at is I talked about our Substack newsletter. And we're going to look at one of the components of that. There's a couple of different pieces to this. The one we're going to look at today is our SORT report. SORT is part of our entry-level Substack online newsletter. There it is right here. It's called Chart Focus. The entire package is called Chart Focus. SORT report is one of the reports that is in the package. The service is $25 a month, and again, there's a free version of this where there are certain free components, pieces of this that you're able to get for free, so you could have a look at it. If you like our approach to investing, make sure you go to asburyresearch.substack.com and at least sign up for the free service. This will give you an idea of what we're doing. Here's our latest report. So this week, the graphic shows that crypto, and we use the ETF GBTC for that, global equities, SPDW, and emerging markets, EEM, are what we call triple greens in the SORT report. You can see they're green all the way across. Here's crypto up top, here's global equities, SPDW, here's the tickers over here, and here's emerging markets, EEM. The SORT report tells us which parts of the global markets have 3 things: positive trends, they're outperforming their benchmarks, and they also have positive asset flows, which means that new money is coming into these ETFs and shoving the prices higher. We have a pretty broad array here. We've got U.S. interest rates, commodities, small cap, crude oil, the U.S. dollar, gold. Gold had been a part of the top 3 for some time. We're since out of gold, and it's dropped out of the triple greens for the SORT report. But so far, GBTC, which is crypto, it's risen by 29% since April the 7th. SPDW, which is the global equities except for the U.S. Outside of the U.S., it's the rest of the global equities market. That's risen by 19% since April 8th. And EEM, which is emerging markets, has risen by 18% since April the 8th. So this is a really great sifting mechanism where you can cover a lot of territory, and this tells you where we have those 3 legs of the stool that we want: trend and relative performance positive money flows. This is updated twice a week. So you're always seeing what's on top and you know where to look for opportunities. Saves a lot of time and gets you to the places that already have the characteristics that you're looking for. So there you go. That wraps up our latest Asbury Research Following the Money podcast. Our next podcast is tentatively scheduled 2 weeks from today, which is going to be on May the 19th. For questions or more information on any of the research models, as we said before, go to asburyresearch.com, go to the contact tab, tell us what you're interested in, and we will get information out to you and see if we can help you to become a better investor. Don't forget to like and subscribe. Have a great Sunday, and we'll see you again in 2 weeks with our next Following the Money.